You're welcome back, video 11A on money and banking, and we'll be dealing with having a look at derivatives. Now, I know this can be a kind of boring sort of stuff, but it's good to know this, and once you get a grip of it, once you understand it, it allows you to figure out what's going on and have a little bit of basic understanding, because it's great for making decisions and for sorting out everything. Now, one of the points I was on there on clip 11, this is just simply a continuation. I'm using the A. Instead of using 11, 12 and 13, I'm using 11A, 11B, and I'll be doing that in everything now because it's quite obvious the way to go. So you know if you see 11, that's on banking. You know if you see an earlier clip, whatever it might be, with a number, then that'll be an extension. So they'll always be on the one topic. Now, so I mentioned there about bonds, and government finances themselves a lot by bonds, and what they look for is private bond holders. They look for Irish Life, M&G, Farrington, or some of those. They always try and get pension funds, any private source of capital. If they're stuck, they have to go to the central bank, the Bank of England in the UK, or the Federal Reserve in America. And so if they have to go to the central bank does not have a source of funding. It does not have its own depositors or its own investors or equity or shareholders. So what happens is they have to print that money. And when it gets to that point, the government is a little bit towards being insolvent. And they don't like that, because when they print money, they reduce the value of the money, and that's known as inflation. And back in the 1970s, there was inflation at the rate of something like around 18% per year. I mean, a bottle of stout, bottle of Irish Guinness, was 10 times the price in 1983 or 4 that it was in 1969. Same with petrol. My first car was, it was a quarter of a pound, that was 5 shillings for a full gallon. That's 4.5 litres, and it went way up, and it's now €1.5 for a litre. So it's massively dearer. So things went up, and all the public service were going on strike, and they were demanding leapfrog pay claims, and they got them. And when they got them, the government simply printed money because it couldn't get its hands on private cash to pay this. So it had to be done by inflation, and Britain was in line with us in inflation. It was all car manufacturing. There was nothing, only strikes in England. You had Dagenham on strike, and you had bus workers on strike, and they used to name a car the Allegro, and they used to call it the All Agro, because it was so much strikes. And so the government simply printed money, and that ended with the EU, and that is one of the good things about the EU. It controlled inflation. So anyway, we had a referendum here that gave the EU the power to check our budgets. Simply this, that the Irish state or the British state had not the mettle or the drive to face down the unions, and the unions hadn't the wit or the sense to see that they're only chasing their tail. Now, so that's all right. Next thing we go to look at how trading is done, and there's the futures market. So the futures market essentially takes wheat, let's say, for Kellogg's cornflakes or maize or whatever, and they know there'll be a crop next year, and they buy it in advance, and the farmer likes to sell it because he wants to know he'll get a set amount rather than take the risk. So of it maybe reducing. So that's the futures market, and it's very simple. And then there's financial instruments, and you're all familiar with insurance policies. You pay a premium, the company insures you against some disaster, your car crash, or the house break, you're going on fire, or whatever it is. The company insures you, and you could insure your livestock, you insure several things, and you often cover that. You often do a thing called offsetting. You insure your no claims bonus, and that's offsetting. And you can see as an ordinary citizen how attractive it is to do all these things, to protect yourself, to put yourself into a common pool. Now, one of the areas where this came in big time was contracts for difference. And when I first heard of these being legalised in Ireland, about 2003 or thereabouts, they were legalised in Ireland and Britain and Australia, I think it is, and some other countries, I was shocked. I was shocked that this took place. I knew it was going to cause trouble. But they weren't legalised in the United States. So essentially what a contract for difference is that you can take out an option. You can book an option to buy shares next year or at some time in the future at a particular price, which is usually the price they are now. And when that day comes, you can buy them at that price. Now, straight away, you should be asking a very relevant question. And you'll get these on YouTube, on the internet, and it's worth looking at. But anyway, Sean Quinn was a very successful Fermanagh-based businessman, a very shrewd businessman. And he had a lot of great men working for him. But they were all in the building area. They weren't in the banking area. And Anglo-Irish Bank was the darling of the builders. It was throwing out money hand over fist. And so everyone was buying bits of land and selling it back to each other and buying it and selling it. And there was no real underlying value. Now I think you know what led to the collapse of Lehman Brothers and the subsequent collapse here of our economy. It led us to have to pay 64 billion euros to bail out Europe's banks and our own banks. But if you don't know enough about that, well, you better check it out. I'm not going to go into it here. But essentially, the subprime mortgages meant that people who could never pay back their mortgages, people who were sick, who were in low-paid jobs, were buying beautiful houses, they were getting loans, and these couldn't be paid. They paid them for a few months, maybe a year or two, and then they went bottom up. They couldn't pay. And they were all bundled into bundles of 1,000, maybe 2,000, and so there was trouble brewing. So Sean Quinn put an option on shares in Anglo-Irish Bank. I think it was in the summer. It was around June 2007, to buy them at the price they were then, about 20 euros a share. I think it was 21, doesn't matter, about 20 euros a share. So that after a particular period, it was a year, he was entitled to buy those shares. And he was fully convinced those shares were going to rise in value, because they had been going up, they had been going up, they had been going up. But he wasn't aware of this concept of the underlying value. And I labour on this point, and I do apologise. That's why with one area I know about, wind energy and renewable energy and all this energy stuff and all this green stuff, you have to look at the underlying value. So the year went round, and a man called John A. Paulson, he was an American investor, and he decided around this time that by time next year came around, the whole thing was going to collapse. And he took out a credit default swap, a type of insurance that if the whole lot collapsed, he could claim a certain amount. It was a bet, essentially. He bet that the whole lot would come tumbling down. Now, one of the differences in insurance and contracts for differences and credit default swaps is you do not have to own the underlying shares. You do not have to have any interest in them. With insurance, you have to show that if the car crashes or the house falls down, that you're going to be hurt personally and you're going to lose out. So you have to show an interest. With these instruments, you don't, because they're traded instruments. It's up to you to trade and deal, and they do not stop anyone coming in. If you want to sell one of these to somebody, you can. And you can sell them on, and other people can buy them on. So you need to be careful of what you're doing. So Paulson made 4 billion by betting on the collapse. So by the time the spring came on, there was talk of banking collapses in 2008, and a person in Dublin rang me that had a few pound in a bank and said there's a bank going to go, and I didn't know where it was and I couldn't advise. And I didn't honestly know. I'd be lying if I said otherwise. All I said is, look, there's something going to happen. It's not looking good. Pull out your deposits. And I think this person did. I'm not too sure. I haven't met them in a while. They wouldn't tell you anyway. You know that yourself. Now, so the next thing was, just about June, the housing market levelled off. It levelled off. And I'm just checking the time there. Yeah, 9 minutes. It levelled off. And Paulson began to bet heavily. He went round all his friends and got all the millions he could get. And he risked everything on these credit default swaps. Meanwhile, Sean Quinn and other people too who took out contracts for difference were sitting waiting on the thing to rise, and they weren't rising. Anglo-Irish shares were not rising. People got a bit jittery and people were starting to pull out their money. But there was no going back. If Quinn had to be able to sell that instrument there and then, let's say at Easter 2008, to someone that didn't know he was getting out, but he couldn't sell it, nobody wanted to buy it. And one of the things about contracts for difference is you can buy at the time you want. If the share price is going up, if you want to keep them, you can keep them another while. They don't tie you down. But if the price begins to fall, they want you to pay up right now. They don't trust you. And you have to go and you have to get the money and you have to pay up. And Irish people may find this very difficult. How do people be made pay up? In the money markets you do. In the money markets they're ruthless. But people don't refuse to pay generally because they have big spreads. So the fellow that would have Quins in the Chicago Stock Exchange or the New York Stock Exchange or the London Stock Exchange, he would have that contract for difference. But he would have another one somewhere else and another one somewhere else. So he'd be able to spread them out. So this is the concept of spread. Quinn had no spread. Quinn had all in Anglo-Irish Bank. And we all know well he was hoping that he'd get the majority of shares and he'd eventually be able to own the majority shares in Anglo-Irish Bank, and he'd be a banker successful as well as everything else. But there's a difference in bricks and mortar, roof tiles, tar macadam, and these things. And people often say, oh, them bankers, you know, oh, them is the bios. But really, you might as well say the same about a bookmaker. That's the name of the game. You've got to know the game you're playing. You don't get into this game unless you know the game you're playing. And of course what happened was the shares in Anglo fell. I think they were only maybe 50 cents or something. They fell to, I think, a 40th of what they originally were. And Quinn got the call. You owe us 2.8 billion euros. And he got a shock. And he shouldn't have got a shock. He got a shock and he didn't pay. And he was kicking up and he was blaming the government and blaming everybody. So they came after him legally and in all his countries, and they followed him with a team of barristers and a team of investigators, and they started taking his property off him. And it went a bit sour, and there was incidents here and there, and people trying to back him up, and there was shouting on the streets. But in the end of the day, that's exactly what happened. It's not that I'm judging Sean. He done a lot of good employment, but that's a typical example of ignorance of the money markets. Nobody should play those games if you don't know what you're doing. And there are several others got clipped at that time. There was another man not far from me, the very same, and they ended up in some cases being told that they have to live on the dole. So that's just the system, and I just want you to understand that system and see is there anything else there. Oh yes, there's a book called Reading the Financial Press. I have it somewhere, and it tells you how to read the financial press, how to take information. Usually the Financial Times and many other papers begin to spot these things, and if you look closely, they're not too slow, particularly the Financial Times, and efforts and things, and you can do the counting. So I think I'll leave that now at 13 minutes. Count now. If I that's I think all. Yeah, I'm coming back now to another part of this, and I hope you find this interesting because I think it is. But just before I leave, there's a thing called Ponzi scheme. A pyramid selling scheme, and there was a Shanahan stamps thing. You can look it up, Shanahan I think it is, on the internet there in Ireland, where you could buy these stamps and they had no underlying value and people invested. There was another thing called Euphemy. It was to do with telephone accounts, and you sold so many to your neighbour and they sold to somebody else, and that's a pyramid selling scheme. And there was another guy in Cavan, we'll call him, I'll not give his right name, we'll call him Michael Malarkey, so there's nobody of that name, and he started innocently taking money and he had nowhere to put it. He was using it for himself, and he began to pay old customers by new deposits, and eventually it appeared in the Sunday paper, one of the Sunday papers. And then everyone came looking for the money, and he had a run, and in that case he had no underlying value. There was nothing. They thought he was investing on the stock exchange. He didn't invest. Nobody knew where it went. And you even got the ridiculous situation where the paramilitaries, the IRA fellas, who were semi-IRA. They mightn't be the real IRA, but they were IRA type people. And there were some other gangsters and some other people. And they actually threatened him at one stage for not taking their money. How dare you not take our money? We'll come after you. And he found himself afraid for his life. Not because he didn't pay them back the money, but because he wouldn't take the money. And he got afraid of them. He knew if he took the money, that if he didn't pay them back, he'd be in danger. And he had to go away. And he was eventually prosecuted and convicted. So I'll not come back on him, but I will come back on some of these pyramid selling schemes in the next video. I'm fascinated by them. And my father used to say, don't give them jail, give them a medal. Anyone that can fool the great and the good should get a medal. So, but this video now just goes into that area of Ponzi schemes. These money markets are not Ponzi schemes. These are genuine ways used every day by business people to hedge their bets and do all that. So right, I'm done now at 16 minutes. Sorry for going so long. Be back in a minute.